Okay, so as far as the, problem 16.5 is where we're going to start. For this problem, we're talking about stock dividends. Alert companies' shareholders' equity prior to any of the following events are as follows. We've got preferred stock, 8%, $100 par for $100,000. We've got common stock at $10 par for $150,000. We've got additional paid-in capital on preferred stock for $16,000. We've got additional paid-in capital on common stock for $220,000. Then we've got a retained earnings for $264,000 for a total of shareholders' equity of $750,000. The company is considering the following alternative items. What we're going to do for each of these items, record the journal entry at the date of declaration and the journal entry at the date of issuance. So we're going to need to know what occurs at the date of declaration, what occurs at the date of issuance. So the first thing is going to be an 8% stock dividend on the common stock when it is selling for $30 per share. So if we're going to have an 8% stock dividend on common stock when it's selling for $30 a share, how are we going to calculate the transaction we're going to record there?
150 shares of common stock times $30 per share times 8%.
So you're saying 150
Shares of common stock.
150 shares of common stock times,
Or it might be a little more than that.
so right now we've got $10 par, 150,000. So you're thinking 15,000 shares. Any ideas, guys? 8% stock dividend on common stock. What would be an 8% stock dividend? How did you calculate that?
I just took the amount of outstanding common stock shares and times it by 8%.
Okay, so you took the number of outstanding common stock shares of 15,000 common stock shares, and you multiplied 15,000 by 8%, and that's how you got 1,200 shares. Okay? How many agree with that? He's perfectly right. So we're going to have here 15,000 shares times 8% is going to equal 1,200 shares. And what is the price, the market price right now? 30 times 30 a share. So what we're going to calculate is we're going to be debiting our retained earnings by issuing this stock dividend. We're taking it out of retained earnings. We're going to transfer it into common stock. So we're going to debit our retained earnings, 36,000, 1,200 shares times $30 a share. The common stock to be distributed will be 12,000, okay? Because we're calculating that by 1,200 shares at $10 a share. And then the additional paid-in capital, 24,000. Does that make sense? So again, we start by taking the number of shares outstanding, 15,000 shares, determining 8% of that, 1,200, at $30 the market share is what we're going to debit to retained earnings. The credit is going to be the common stock to be distributed at par, And the net difference is the additional paid in capital. Because do you see how the common stock is at $10 per share? Got it? Next one, B. Oh, sorry. B is, this is what we do when we declare it. And then once it's distributed, what are we going to show? We're going to show our debit of $12,000, and then it becomes $12,000 of common stock, $10 par. We've already debited our retained earnings. We've credited our additional paid in capital. The only difference we're going to do is get rid of the common stock to be distributed, and now it's just common stock. Any questions on that before we move on? Okay, so the next one, number 2. A 30% stock dividend on the common stock when it is selling for $32 per share. So a 30% stock dividend. So we should be able to, based on what we did the last time, and figure this out. A 30% stock dividend, we would take 15,000 shares times 30% gives us what? $4,500 shares?
Yep.
4,500 times $10 a share, right? That's going to be 45,000.
I thought it was $32. No, it's over 25%.
Remember, we had a problem like that last week. Once that goes over 25%, you don't do based on market value. You do it based on par value. You guys remember that? So if you have a question regarding a problem like this, you're going to need to know if it's under 25%, it's going to be handled one way. If it's over 25%, it's going to be handled another way. So 45,000 is your retained earnings. Your credit is 45,000. Yes?
Just to make sure I've got it clear, so if it's under 25%, it's the whatever it's at, and if it's over 25%, it's at par.
Just at par. Okay?
And that includes 25%.
I believe it includes 25%. So basically, when we at declaration, it's going to be 45,000, and then once it's to be issued, 45,000, and common stock 45,000. The next thing, the next special situation, a special stock dividend. A special stock dividend to common shareholders consisting of 1 share of preferred stock for every 100 shares of common stock. The preferred stock and common stock are selling for $123 and $31 per share respectively. So we've got a stock dividend to common, 1 share of preferred for every 100 shares of common stock. The preferred stock is selling for $123, common stock $31. So how are we going to handle this one? How many shares do we have of common stock right now? 15,000 shares. If we divide that by 100, that's going to end up equaling 150 shares, right? Am I right? 150 shares of preferred stock, and that's right now valued at $123 a share. Is that right? So we've got 150 shares of preferred stock at 123 is 18,450. The preferred stock to be distributed is, what is the share price, the par value? Is it $100? The par? $15,000 is the preferred stock. The additional paid in capital, $34.50. Then once it's once we have the date of issuance, what we'll do then, the preferred stock to be distributed, $15,000, and preferred stock now is a credit for $15,000. Anybody have any questions on this? Is it making sense? Yes, no? Okay? Number 4 is a memorandum. So, number 4 says a 2-for-1 stock split on the common stock, reducing the par value to $5 per share, assuming the same date for declaration and issuance. The market price is $30 per share on the common stock. What would we do here? Basically, and I'm sorry I somehow deleted that. For number 4, you would have a memo, common stock split, 2-for-1, par value reduced from 10 to 5. Okay? Next, can I move on? Next, a property dividend to common shareholders consisting of 1,000 shares of West Company common stock. This stock is being carried on the Nance Company books as an available for sale investment at a fair value of $48 per share, which is also its cost. It has a current value of $54 per share. So we're dealing here with a property dividend that's going to be 1,000 shares of West Company common stock. How are we going to handle this one, guys? So, investment in West Company stock. The way we're going to calculate that investment in West Company stock, 1,000 shares times the difference of $54 minus the $48, which is going to show on our books of 6,000, and the gain on disposal of investment, 6,000. Then, as far as the retained earnings go, we've got 54,000 is going to be debited from retained earnings, 54,000 in property dividends payable, and then when we issue it, we're going to have a dividend, 54,000, and then a credit to investment in West Company stock. So we're showing the gain here because we had it on our books at 48. Okay? So we're showing the gain on this piece and then reducing our retained earnings, and then from here ultimately reducing our investment. Any questions on that? Unless I hear you guys say slow down, I'm going to just keep going, okay? A cash dividend consisting of a normal dividend and a liquidating dividend on both the preferred and the common stock. The 10% preferred dividend includes a 2% liquidating dividend, and the $2.30 per share common dividend includes a 30-cent per share liquidating dividend. Separate liquidating dividend contra accounts should be used. So we're issuing a cash dividend. We're going to have a normal dividend and a liquidating dividend. So the preferred 10% includes a 2% liquidating dividend, and the $2.30 per share common dividend includes a 30-cent per share liquidating dividend. So basically what we're going to do here on the dividends, with retained earnings, we're going to start at 1,000 shares times $8 plus 15,000 shares times $2. So we've got 1,000 shares at $8, and we've got 15,000 shares at $2 to total 38,000. Okay? Yes.
Can you explain where that dividend of 2 comes from?
Yes. So a cash dividend consisting of a normal dividend and a liquidating dividend on both preferred and common. The 10% preferred includes a 2% liquidating, and the $2.30 per share common dividend includes a 30% share liquidating dividend. So basically, do you see how the preferred dividend shows so the normal dividend is 8%, and the liquidating portion of this is 2%. The common stock, the dividend is $2.30. 30 cents of it is the liquidating. The $2 is the common, or the regular. So what we've done here is we've taken our 1,000 shares times $8. Instead of a 10%, $10, since $2 of it is a liquidating dividend, we've got our 1,000 times $8 a share. And over with our common stock, the total dividend is $2.30, but 2 of it is the regular dividend. So we're just taking the portion that's not liquidating, showing it here at 38,000. Then as we move on, contributed capital distributed as a liquidating dividend on preferred stock is going to be the 1,000 times $2 a share, or 2,000. And then our dividend, the liquidating portion of the common stock, 15,000 shares times 30 cents, 4,500. The dividend payable for preferred stock is going to be 10,000. That's the whole 10%. The dividend payable for common stock is going to be the entire 15,000 times $2.30 a share,
Can you put the screen up?
or sure, 34,500. Oops. Whoops. Does that help? Oh, guys, sorry. I'm trying to.
If you can find the bottom of the Word document, you should be able to put that minus.
There. Any questions on that? It's about as tough as it gets.
Are we gonna do another one similar to that? Or are we gonna order another one? Cause that 8 and that 2 is still a little confusing to me.
Okay. So the preferred stock, the normal dividend is an 8% dividend on preferred stock, but they're increasing it to a 10% dividend because $2 of it's a liquidating dividend. Okay? So since they give us the information that 2% is liquidating, we know that the regular dividend is 8%, or since the par value is at 100, $8 a dividend per stock. So we're taking our 1,000 shares of preferred at $8 a share for a cash dividend, and then it tells us that the dividend on the common stock is $2.30, but it tells us 30 cents of that's going to be a liquidating dividend. So the real cash dividend is $2 for 15,000 shares. Does that make sense? And then the difference is the liquidating dividend. Yes, dear.
I'm just wondering if you can explain exactly what a liquidating dividend is.
A liquidating dividend is basically reducing there is additional like paid in capital or contributed capital on top of, usually you've got a par value, and then above that par value you've got this additional contributed capital or paid in capital. Basically they're taking a portion of that dividend and reducing it out of that additional contributed or paid in capital. Instead of it coming from cash per se, it's being reduced from the additional money sitting out there in retained earnings already, or in the additional stock. You know what? Let's Google this, okay? Let's Google it. Liquidating dividend. Liquidating dividend is a type of payment made by corporations during its partial or full liquidation. For the most part, such a distribution is made from the company's capital base, and it's usually not taxable to shareholders because it's basically a reduction of the retained earnings. It's like giving them back a portion of their stock they've already contributed. This distinguishes a liquidating dividend from regular dividends, which are issued by the company's operating profits. So maybe one or more installments. Corporation paying out liquidating dividends will issue its shareholders a dividend showing the amount of the distribution. That doesn't really help us. Liquidating dividend. Let's look at this one. A dividend paid to shareholders out of the company's capital rather than earned income. Liquidating dividends occur when the company pays more than its total profits and dividends. This usually happens when shareholders believe the company is no longer sustainable or profitable. Thereby, liquidating dividends are considered a return of shareholders' investment rather than profit. So basically, it's coming out of what's already been contributed by shareholders to the company, or that capital, paid in capital area. And they're getting it back. Yes?
That account we debit, is that a contra account or do you directly?
It is a contra account. Yes, it is. How many of you are familiar with what a contra account is? It's account, like we've got depreciation on assets, so we'll have an asset, then we'll have a contra account like accumulated. So it's part of your assets, but it allows you to keep track of the detail of that contributed capital, or a reduction in this case of contributed capital that's going back. Okay, guys, next for 30%. For each of the journal entries, do the date of declaration and the date of issuance. I guess what we need to do now here is, this was the date of declaration. Now the date of issuance, dividend payable preferred stock is 10,000. Dividend payable common stock 34,500, and our cash is going to get reduced 44,500. Okay? Okay, so then the next portion of this problem compute the balances in the shareholders' equity accounts immediately after the issuance. Any gains or losses are to be reflected in the retained earnings balances. We're not going to worry about income taxes on this, okay? So, as we go back here, we're going to talk about preferred stock, common stock. Here, let me reduce this some. So, our preferred stock for number 2, on number 2, excuse me here, let me get rid of that. The, excuse me, number 2. Or do we start with 1 here? Okay. So with 1, what did we start the stock with? If we look at this problem up here, how much did we start with? 100,000, didn't we? See that? And the common stock was how much? 150. So the question is, how much did we end up with after the issuance? An 8% stock dividend on the common stock when it was selling for $30 per share. So we know in this scenario, let me make this 1. Our preferred stock didn't change, did it? So it was at 100,000, right? Our common stock, we started at 150,000. How much did we add to it? Guys, how much did we add to our common stock? 12,000. You see that? So we added 12,000 to already 150. That gives us 162,000. How much was our additional paid in capital on preferred stock? Here, 16. See in the book, it said 16. Do you guys see where I'm looking? So that was 16. Additional paid in capital from stock dividends. Oh, excuse me. Additional paid in capital on common stock. What is this here? 220, right? And then we've got additional paid in capital from stock dividend. Did we start with anything? No. But what do we have for a journal entry here? 24,000. See that, guys? See that 24? 24,000. And then what are our retained earnings going to be? We started with retained earnings of 264. What did we reduce our retained earnings by?
36,000.
36,000. So 264 minus our 36,000 gives us what? 228. So what is our total shareholders' equity? What did we start with, guys? 750. What are we going to end with? 750. We're just altering the numbers, taking it out of retained earnings and transferring it over to increasing our common stock and our additional paid in capital. Any questions on that? We're basically taking each of those scenarios and we're just showing how the stockholders' equity section changed. Okay? So let's look at number 2. Did anything change with our preferred stock in number 2? Let's look back here. It said a 30% stock dividend on the common stock when it is selling for $32 a share. Did anything change on preferred? It didn't, did it? So it's still sitting here at 100,000. What about our common stock? What happened there? We started at 150. And then what did we change? Up here at number 2. It went up 45,000, didn't it? So our 150 plus the 45,000 is going to have common stock at how much? 195. Our preferred paid-in capital didn't change. Our additional paid-in capital on common stock didn't change. But what happened to our retained earnings there? It started, how much did the retained earnings start at? 264. Where's it at now? Didn't it all come right out of retained earnings, the 45,000? So 264 minus 45,000 is what, guys? 264 minus 45,000 is 219. But guys, it's still 750. See, all we're doing here is just altering the stockholders' equity section. It's staying the same. We're just reducing the retained earnings portion and putting it into common stock. Okay? Why is this one different from number 1? What happens if the dividend is over 25%? You use par. Okay? Any questions on that? Should we move on to the next one? Number 3. Now I think something happens different here, doesn't it, to preferred stock? What happens, let's go back here with number 3, a special stock dividend to common shareholders consisting of 1 share of preferred stock for every 100 shares of common stock. The preferred stock and common stock are selling for $123 and $31 respectively. So our common stock hasn't changed. That's still at $150,000. What's happening with our preferred stock? It was at 100. How much does it increase? When we look at number 3 here, how much did it increase? 15,000? So we're going to show an increase of 15,000 here, or 115,000 is now our preferred stock figure. Do we have any additional paid-in capital on preferred stock? Look at our journal entry. Do we show any additional paid-in capital? We do. How much? $3,450 is the additional paid-in capital from stock dividends. So we're gonna, it doesn't affect our additional paid-in capital. It's basically coming in here, additional paid-in capital from stock dividends of $3,450. Are we going to change our retained earnings? How is our retained earnings affected with this transaction? Go back to number 3. Our retained earnings went down $18,450. See that? So what's going to happen to retained earnings? What's the new figure here? 245,550. But you see how our total stockholders' equity Still remains the same, doesn't it? If you had a question that said, in issuing a stock dividend at the end of the period, how does that alter your total stockholders' equity section? Does the total still stay the same? Okay. Number 4. Number 4 here. What happens with number 4? Did preferred stock change? Bless you. Nothing changed, did it? Remember we just did a memo? Just noted that the par value changed? So we're not going to change anything here. Okay? Nothing changed there in number 4. That was a stock split. How about number 5? What's going to happen with number 5? Is preferred stock changing, or is common stock being changed here? Neither. What was affected only? Retained earnings? Right? And what is our new retained earnings balance? What happened there? We started the period with how many dollars in retained earnings? 264, right? So we started with 264,000, and then what were our retained earnings? We subtracted 54,000, and we added to that the $6,000 gain. So what's that balance to? 216,000. But look, guys, we still have 750,000, don't we? Okay. Now, our last one, number 6. How are we going to change that one, guys? What was affected here? Was our preferred stock affected? No. Common? No. Additional paid in capital? No. It was a property, what was it?
5 was
The
a
last
property
one,
dividend.
I don't have 750.
It should be 702.
702. Gosh, yeah, 702 here.
Because of the property dividend.
We only changed retained earnings.
702 is number 5. I'm sorry. And what's going to happen with number 6? How much is that going to change to? The liquidating dividend was minus 2,000, right? Minus 2,000, and the contributed capital, the liquidating dividend on common stock, was minus 4,500. And how did that affect our retained earnings? If we go up here, how did that affect our retained earnings up here? 38,000. So 264 minus the 38,000 is what, guys? 226. So our new retained earnings here is what? How does that lower? Yes. Someone have a calculator to total those numbers?
705, 500.
705, 500. 705, 500. Any questions on this?
Could you possibly scroll up just a little bit?
I'd love to. I'll bring this in so you guys can see it a little better. Actually, you've got that portion, so I'll just do that.
So, I have a question. On number 5, because retained earnings goes down, it's balancing on like the asset side, I'm guessing, because of the, because of like, it's property.
That's the investment. So since the investment went away, the cash got reduced, or the investment in, think of an asset, you know, that was a marketable security, so that investment was credited. So the asset was reduced, you know what I'm saying? And then your stockholders' equity was reduced equally.
Right. So then where would it balance in number 6? Is it the same?
So in number 6, the 2,000 and the 4,500 gets reduced. The cash was reduced. Okay? And so as a result, there's your balance. How are you guys doing? Any questions? Okay.